afternoon, and thank you everyone for attending today's webinar, Valuation Considerations in Healthcare Industry, presented by Howard Krieger of Withum Smith & Brown. Please be aware that there will be a question and answer portion today at the end of the webinar. To avoid frequent interruptions during the webinar, please type your questions in the question box located to the right of your screen. They will be answered in the order received during the question and answer portion. Additionally, an electronic version of this presentation will be emailed to all participants following completion of today's webinar, and a recorded version will be available on the website for members only. Again, NJMGMA would like to thank you for attending, and I will now turn things over to Howard.
Thanks, Alex, and thanks everybody for taking time out of their lunch to join. The topic of valuation in healthcare services is quite broad and generic. When you think about all the various industries that overlap and component entities that make up healthcare services, it's really hard to find a one-size-fits-all as it relates to valuation. So to that end, if there's anything I don't address or there's an area you want to dive into, there is a Q&A period, but certainly feel free to follow up afterwards. And I'll do my best to keep this as generic and specific at the same time as possible to make it relevant to as many folks as possible. So I'm going to divide the discussion into basically three areas today. I think a good way to kick this off is to help you develop some empathy into the mindset of a valuation professional. A valuation professional has more in line with one of those appraisers from American Roadshow that tells you how much a cabinet's worth than say they do with say a tax professional or even an accounting professional. The latter two having more to do with how do you fill out forms and meet requirements set up by regulators to meet certain reporting requirements, whereas as a valuation specialist, at the end of the day, we're really trying to come up with what something is worth, quote unquote, but in the context of the definition of value. And so the first third of the presentation, we'll talk a little bit about what the different standards of value are and the thought processes that go into determining what the right standard of value is and what that even means. Then we're going to talk about the various approaches under each standard of value, and then we'll wrap up with an example as well as things that one should look for when retaining a valuation specialist. If I could tease that last point a little, one of the things you'll note is that there's a big difference between doing a valuation in a litigation setting versus doing a valuation in a merger and acquisition setting, and still a different set of skills needed to do evaluation for tax and financial reporting. And so if you are retaining a valuation specialist, just kind of a word to the wise, vet their specific experience performing a valuation for the need you had in mind, as opposed to just hiring someone who says, yeah, I can do a valuation. So personally, background, spent a number of years in the banks, actually in consumer finance, was with KPMG for a number of years as a technical leader doing complex valuation and business valuation, and then joined Withum about 3 years ago, where I lead the corporate value group. And we, just by Withum's background, we do a lot of healthcare in New Jersey. So we've picked up a lot of fair market value studies for START compliance, as well as working with healthcare systems related to built-in gains tax calculation. And then of course, partnerships. If you have like a physician group or something, they'll merge, and what they put in the agreement as quote unquote value isn't consistent with what the tax authorities consider value. So we help folks kind of manage those differences. So how a valuation specialist thinks about things. When you're talking to a valuation professional, about a particular need. They are going to be listening for triggers and keywords so that they can perform the math exercise necessary to meet the need. I think one of the mistakes a lot of the new folks that come into valuation make is they think they're going to come in and be an investment banker and help do deals and all sorts of fun stuff. And the reality is, 8 times out of 10, or I guess two times out of 3, the exercise is one of, hey, a regulator has contacted me, an auditor has reached out, or I'm thinking of selling or buying. I have a number in mind. Can you tell me if that number makes sense? Or the regulators challenging something I did. Can you show them that what I did is okay? So a lot of times it's not so much coming from the ground up and creating a number or a value from scratch, but really trying to justify, bolster, or poke holes in a number that's already kind of floating out there. So the first thing we'll think about is, what's the need? Valuation. And then we'll think about the purpose. Here I listed out financial reporting and tax, if I start at the top and work my way down. But you can also add, to the audience on this webinar, Stark compliance or some other regulatory concern. But in this case, let's pretend financial reporting was the purpose for the valuation. A number has to be put into an audited financial for a not-for-profit or a for-profit. So the question becomes, Howard, how is the value I'm reporting on this financial statement correct? Well, then I'll think about various approaches. So after I know the purpose, I know I have a basket of approaches I can choose from, and we'll talk about each of these later on. An income or cash flow approach, a market approach where we're thinking about multiples, or just a plain old asset approach, like what's my balance sheet worth? After the valuation specialist then considers the best approaches, they will then pick methods under each approach. And these methods are not pulled out of a hat. This is something where the industry has been around long enough at this point where you have a lot of really smart folks that have boiled down or reduced every tactic taken and technique applied to get to value and bucketed it into these discrete methods. So much so that all the guidance that's out there on how to value a company now falls into these discrete methods. And if you go off the reservation and do something that you feel, quote unquote, is right, and it's not consistent with how these methods are to be applied, depending on the guidance, it's going to get flagged or rejected and just cause problems. So understanding that each of these methods has in itself a series of procedures or tasks is important. And then, of course, what do you ultimately get? Oftentimes, schedules or a series of Excel spreadsheets with a good conversation may be enough to give the intended user what they need to move forward. But if you are addressing a regulatory need, then either a memo, which is not an opinion of value, might provide enough information to move forward. Perhaps a cover letter consistent with like a memo might be enough, but sometimes a full-blown appraisal report is required. And in the case of Stark, you might actually need a fair market value study consistent with what has now become expected with Stark compliance needs to be put together. And so a full appraisal has rules that need to be followed to be considered legit, and so do studies. So this is what a valuation specialist is thinking about. What's your purpose? What approach am I going to take to actually come up with the number? What methods are going to produce the most reliable outcome? What are the procedures that have to be done? And then ultimately, what's the deliverable? And all that's going to factor into how much it costs and how long it's going to take to get there. So some key takeaways from this presentation and from that prior slide. The purpose of the work, so I'm going to flip back and forth, hopefully no one gets too dizzy. So the purpose, if I'm looking here at the top row, sets what the appropriate standard of value we have to use is. And we'll talk about standards of value in the next series of slides. The standard of value is going to determine what methods are employed to come to a value of whatever it is we're valuing. We call them subject interests in this example. And then the different methods may result in different values for the same subject interest. So there's this big conundrum where, here's the summary, right? That if there's more than one purpose to the analysis, then you might be forced, or the valuation specialist might be forced to employ two different methods to come up with a number, and the conclusion may be different. So a big head scratcher for the intended user is, how does the same thing have two different values? How does a 1% equity interest in my practice or my healthcare system or my support industry, how could it result in two different values? And very simply, the path taken to arrive at the conclusion might lead you to two separate results. Now, any appraiser worth their salt should be able to provide a reconciliation to the intended user as to what is driving the difference, so that depending on the context of the analysis usage, the intended user can provide some color. All right, very good. And subject interest, capitalized term, could mean anything. So here we talk about certain typical practice offerings that an appraiser provides. Always good to know the broader capabilities of your tax specialist. Let's talk about a way to think about value, right? So what is value? $1 million question. A value of a business is equal to the present value of the future benefits of ownership. I give an example of a lottery ticket that where there's a $400 million jackpot and a 1 in 200 million chance of winning. So if you take out taxes and having to wait and all that stuff, what's the ticket worth? Well, very simply, it's the $400 million future benefit divided by the risk of getting that benefit, or 1 in 200 million, or around $2. So the value of the ticket is worth $2. Very simplified example there. Second, value is not always a single number. Like we just mentioned, that depending on what it is, your purpose, what the purpose of the valuation is. And people don't think about it like that. A lot of times they think about the thing they're valuing. What is 1% ownership worth? The real question is, why do I need a valuation? And depending on the purpose, you could end up with a different number to the result. And we always like to say that business is as much an art than a science. Well, I like to tell my folks, look, there's enough guidance out there. Just a quick Google search on how to do a discounted cash flow method. There's enough detail and science out there that valuation is as much a science as it is an art. So the art argument may work to support why there is not a great precision around a result, but ultimately there is enough science out there to get to a reasonable number for just about anything. The other key point is valuation is based on a specific previous point in time. You cannot appraise something in the future. A relevant example, because it is September 12th, is if you were asked to value something on September 11th, say down in the World Trade Center area, well, you cannot know what happens on September 11th. So if you were valuing something on September 10th, 2001, or as of, you cannot know what happens on September 11th, 2001. The rules required in an appraisal are that only known and knowable information can be considered. And then also shelf lives may vary depending on what it is you're valuing. A lot of times I had a request today for a value as of December 31st, 2016, because someone wants to gift some shares of stock, but they want to do the gift now. Well, a 9-month difference in time is not going to be not a reliable value indication, and it would not work for tax purposes. So I'm going to skip through the triggers. Let's talk about some of the subject interest types. You could have physical property, debt or equity, contracts or service agreements, and these are critical for STAR compliance. All of it falls into either tangible assets, things you can feel, and intangible assets. These are both specializations that require unique appraiser qualifications. So it would not be, make sense to hire an appraiser that might be really great in intangible assets that's never valued a piece of equipment, or vice versa. In fact, most times if you're talking about, say, a ambulatory surgery center or a radiology practice or a hospital, you probably need both. And your appraiser should be thinking about, if you're contacting someone that does business valuation, they should probably already have in their pocket a tangible asset person. The other thing to consider with subject interests is control and minority or minority basis, and then also the ability to move the subject interest easily. Why does it matter? We often get phone calls of folks that, hey, I'm thinking of buying a practice. Could you give me a ballpark on what the whole thing's worth? Or rather, I'm thinking of buying into a practice, or I'm thinking of selling a part of a practice. Well, if you're selling or buying a minority interest, well, there might be certain restrictions, and the value of that minority interest is going to be significantly different, sometimes 10, 20% different than, say, the value of the whole. So when you are thinking about what it is that's actually being valued, does that interest that's being valued have control or not? And is it marketable? Is there an ability to convert to cash very quickly? Odds are, if it's a business, the answer to that is no. So purpose has specific meaning. So if you're doing a purchase price allocation, or if you're doing something related to M&A, or if there's a legal issue, or succession planning, or tax issue, or if you're looking at shareholder and partnership agreements, each of these purposes have coupled to them various guidance which sets the rules the appraiser must follow to come to a value conclusion. Standard relates to the intended user, and the rules that have been established relate to the value. So if if this is a dispute issue, well, fair value is a term used by the courts, and the factors that go into determining fair value for litigation might be completely different than fair value under financial reporting or fair market value under tax. And you find circumstances where in the litigation setting, the use of subsequent information is certainly considered, because they're thinking more about fairness and less about, are you following this specific recipe that the IRS has set forth or that the FASB has established. So standard also defines or specifies the parties to the actual hypothetical transaction. So for instance, if you are doing evaluation for tax purposes, you are to consider what a willing buyer and willing seller would agree to under no compulsion to buy or sell. Well, what's a willing buyer or a willing seller? Does that mean someone just showing up with a checkbook? Generally speaking, yeah. But if you're talking about fair value from a financial reporting standpoint, you have to consider market participant in a principal market. Well, me with a checkbook is not a market participant as it relates to buying a hospital. That would likely, the limit of what falls into a market participant in a principal market are going to be folks that are already in that industry. So why does that matter? Or if it's STAR compliance, before I say why it matters, if it's STARC, you actually have to exclude from your analysis entities that could benefit from doing business with the entity being valued. So, how then the universe of comparable companies or the universe of considerations that go into the value are right off the bat different depending on the standard that is used. Huge issue. So these are 6 different standards of value. The definitions are in here, and you could totally look at those after the fact. But given our time restriction, we'll focus on a couple of pertinent ones. Fair market value, this is for anything tax. Gift and estate, transfer of entities. One of the things we see often is as these health systems kind of gobble up different entities or take interests in various entities, or as private equity firms start taking more of an interest in healthcare because of the very nice returns, that things start to get moved around. Well, once you move an investment between 2 legal entities, you may trigger a tax issue. And so the math exercise may be something as simple as, look, Howard, we paid $1 million for this thing a year ago. We don't think it's worth anything different, but the IRS wants an independent appraisal to prove that. So now you have to look at what was paid and what the impact of transferring it, how it affects fair market value, and all of the things under fair market value apply. So fair market value, tax. Fair value could be financial reporting, or it could be litigation. The definitions are different, and then also the considerations that go into it are different. Okay? Fair market value and financial reporting are aligned. The definitions are close, but not ideal. Litigation, completely different. It really has to do with fairness when it comes to fair value. Investment value, I will talk on very quickly, really is someone coming in and wanting to make a purchase of an ownership interest might be willing to pay more than the value concluded under fair value or fair market value, because investment value tends to think in terms of high growth, synergies, and quick exit. And so if you're thinking about what you would pay for an entity, you really don't want a fair value or fair market value. You really want an investment value. Comparing and contrasting fair value and fair market value, we talked about willing buyer, willing seller versus market participant. And then also the biggie is under fair value, discounts may or may not be considered. And that's both in litigation and in financial reporting, where fair market value, the discounts are considered, but may not be applicable. General market value is the public health standard, and you see here the citation, 42 CFR 411. General market value was built off of the fair market value definition and strictly was amended to include not other, business buyers and sellers not otherwise in a position to generate business for the other party. So why, I'm trying to see if I have this, why would there be such a difference in value under this stark definition, under the general market value definition relative to the tax code? Think about who is looking at your value conclusion. We talked about how the purpose is the most important element of a valuation. If the purpose of the valuation is an owner of a company looking to sell a portion of itself or to attract investors, they are going to be thinking about the synergies and the impact on value from that perspective, and not really concern themselves with whether or not the result meets these tax and financial reporting or litigation assumptions. Fair value under the financial reporting definition and fair market value under the tax definition were put in place to make the lives of the reviewers easier. Who are the intended users of those valuations? Well, fair value in the context of financial reporting, it's going to be your auditors. And then under fair market value for tax, it's going to be the tax inspectors. So they needed a recipe that was fairly cookie cutter, that if they picked up a valuation that claims to be consistent with the guidance they've put out, they could quickly go through, check the box on what was done, circle where the appraiser did something different than what its guidance suggests to do, and therefore they could very quickly resolve, does the variance from the guidance matter? You know, if you jogged off the trail a little bit because you have a special consideration for this subject interest value, is it a material problem, or is it something that looked like it's avoiding a penalty? So fair market value and fair value in the context of tax and financial reporting respectively was meant to really deal with standardized notions of value. General market value, which is again the Stark one, and fair value under the litigation premise, is really kept nebulous on purpose because they want to encourage the conversation and not lock jurists in to a conclusion because one party followed the recipe better than another. In fact, this was from the SCOTUS blog where it talks about this, where basically the general market value definition has subjectivity and arbitrariness built in because, again, they're trying to, a uniform set of standards would have extremely limited value. If there was a uniform way of coming up with value under the anti-kickback statute or under a litigation scenario, it would really not help the process of figuring out whether or not there's an issue. So we talk about fair market value, which is for tax, fair value under the two premises, and then general market value. Here's how you would generally apply it. Estate and gift, fair market value. Buy-sell agreements. So if you have two partners, two physician practices that are looking to merge together, the standard of value in that agreement is basically going to be some mutual agreement and not fall under any of these standards. You might have an investment value under a strategic acquisition, and so forth and so on. Let me see. Other damages cases and antitrust would be federal case law. So let's talk about, we're going to get into now the meat and potatoes on how to actually value stuff. One of the questions that I get asked frequently is, I have two partnerships that merged and they are trying to calculate the built-in gains tax, or they want to look at what was agreed to in the merger agreement and use that as a basis for fair value or fair market value. Unfortunately, those agreements do not produce, you can see here from what we've talked about, do not produce a standard, a value conclusion that meets these standards. Oftentimes when partnerships join with one another, the goal is to get everybody to an equal playing field from an equity perspective, meaning that if you have a small practice and a large practice, the merger agreement simply says, look at your receivables, look at your payables, look at how much the capital account is for the owners in each, and what would we need to do to get everybody level in consideration of receivables and payables and the amount of cash they've already put in. So that exercise with the cash boot and the equity exchange really gets everyone to a level playing field. You still would likely need someone to come in and come up with fair market value in accordance with the tax definition in order to calculate the built-in gains tax and file accordingly. Just a very important point that agreements don't produce fair values, and formulas in agreements about how you're going to get bought out down the road, using some recipe that was crafted at the time the arrangement was made, may also not result in fair market value and can be problematic because that's written by lawyers and owners and stuff and not valuation professionals. Okay, so the premise of value, another term. So you generally can have two premises. One, that a company will continue to operate and have earnings capacity going forward. Or two, liquidation, meaning that the company won't have capacity going forward and there'll be some kind of liquidation event, either orderly or forced. And those premises have to be substantiated when you're documenting under any standard of value. So regardless of the standard of value, you have to call out the premise that you are using to come up with a number. Generally speaking, it's a going concern. If it's in liquidation, usually appraisers don't get brought in. They just look at what's on the balance sheet and kind of guess. So the three approaches under value: asset, market, and income. Asset, you add up the individual values of the assets on your balance sheet to get a total value. A market approach, a good example of a market approach is, hey, your neighbor's house just sold for, a couple $100,000. You have a very similar house to your neighbor's, so what's your house worth? And then you would just look at the differences between your house and their house and go through and try to figure out what your house is worth based off of what your neighbor's just sold for. That's a market approach. An income approach is where you look at expected cash flow from the business and then use either an earnings multiple in the form of a cap rate or a discount rate against the cash flow to come up with a value. So the key there is it's that lottery ticket. It's how much is this business going to kick off? What's the risk of the cash flows kicking off from that business? And therefore, what's my value? A lot of times that discount rate and the expected growth rate can be turned into a multiple, and that's what's described here. Normalization adjustments may be necessary under all approaches. It is very important to consider that value from the perspective of fair value, financial reporting, fair market value, tax, and general market value for Stark are not really concerned with how the business has been running itself to date. They are more concerned with what these entities in the ether, these magic buyers and sellers that are regarded, how they would run a business. So if a small practice has a habit of helping folks out with the physician owner's kids' college education or going on vacations or other discretionary items, if those are in the financials, you got to take those out. Further, if you have owners that don't take salary, but in a typical type entity that serves that need in the marketplace, they would take a salary, you have to undo that distribution and then turn it into a salary expense. How do you know what to choose? Look at industry reports. You reach out to a valuation person that has access to those industry reports, or just Google. The information will be stale, but you can make the argument, at least out of the box, that look, has really the percentage compensation relative to revenue changed all that much in the past 2-3 years? So you want to make sure that all the adjustments you're making are appropriate, and also those adjustments may only be appropriate if you're talking about controlling versus non-controlling interests. So let's a little deeper dive into each. The asset approach is based on the principle of substitution. Generally speaking, it produces the floor value. You do the asset approach by going through all the assets on the balance sheet and determining whether or not someone would pay what you have that asset listed on the books at, or if they would pay up or down based on the usefulness of the asset. And the way you figure that out is by figuring out the cost to reproduce or replace it. More often than not, going concern value of the company exceeds the value under this approach. I like to think about the asset approach as being one that does not consider the goodwill or the intangible assets generated by a business. You have an ASC or a health or a hospital or something out there in the boonies where no one else can get to, and let's say they have a great reputation. My kids were born at St. Barnabas, which has a great reputation for like difficult pregnancy, handling difficult pregnancies, right? Well, there's an intangible value there which may draw people from outside the normal area, and that would result in future expected higher cash flow and value. Your asset approach is not going to pick that up. Your asset approach is only going to pick up what the current value of all the stuff you have on your balance sheet is. The market approach is the polar opposite. It tends to use the principle of substitution by looking at items that were recently sold. Well, everyone knows that if you're trying to close a deal, a lot of times you pay up to close the deal. So in effect, you have a situation where looking at raw transaction amounts may result in the highest value conclusion for no other reason than you are looking at just deals that close. So you're looking at synergies, you're looking at control, you're looking at consummated transactions. All the intangibles that are out there are jammed into that number, and so that tends to produce the highest number. Under the market approach, you have to find comparable companies. These are some of the entities or research databases we use to find those. Again, you can do a Google search or reach out to a valuation professional and see what their latest industry reports are from Pratt Stats, IBA, Mergerstat, etc. The guideline public company method under the market approach has you compare to public companies. But again, if you are a small private entity or a partnership, there's a lot of adjustments that need to be made. Valuation professionals can do that, so you don't throw out the public company method. And I'll tell you another a key reason why never to throw out the public company method. Think of who the stakeholders are. If you're a public company, you are beholden to the SEC and all the shareholders. And so the way you run a business when you're public is a heck of a lot different than if the business is just physician owned and they're willing to just to take the distributions after tax. They're also managing two different things. A public company might be managing, again, to maximize the share price. A private company is going to be managing to reduce its tax burden. Here's a sample of some transaction data where we were looking at home healthcare agencies. And so you could see total equity value to last 12 months revenue, total equity value to EBITDA, and you get an idea of the range of multiples and the type of data that's out there. If you are looking for sales transactions to say, well, what are people paying for X, Y, and Z? That information is very limited and is published by brokers. And so it's not always something that you can rely on in terms of relying on actual sales of entities, and the data may be stale. So you just want to be cognizant of that and use it for triangulation. So if the asset approach produces the lowest value because it doesn't consider, say, all the intangible assets your business has generated, and the market approach is producing the pie in the sky number because you are comparing your entity to closed transactions, the income approach I like to think of as right down the middle. You look at projections from the entity. You could even just take the last year of the company's production and try to roll it forward into some stabilized estimate. You are taking a measure of risk, which theoretically, if you like to nerd out on the statistics, you can look at what the discount rates mean from a whole white perspective, and you're really covering the whole gamut of nonlinear payoffs. And so as a result, your discount rate against those cash flows covers both the up and the down, and that gets you to a value. So when you're doing the income approach and you're developing cash flow estimates, we tend to look at public companies. So or not public companies, but we look for other companies' comparative data to make sure that our margin estimate is right. So here, if I'm looking at gross profit, this is for radiology companies, right? So this is radiology entities. So if the gross profit margin of my subject entity is 50%, and I look at the industry mean and median is 73 and 85% respectively, well, then I have to think maybe my company has got their thumb on the scale a little bit, and there's some discretionary expenses I need to take out. So always an avenue that needs to go down is how does my entity line up with the industry, especially here where we're talking 60 entities of data. I mean, gosh, that's pretty, then again, though, it's, 20 years of data. So you have to always consider the source, as my boss used to say. So we discount future returns or capitalize earnings. In discounting future returns, you forecast out 5 to 10 years, hit it with a discount rate. That's one of the gotchas too when you hire an appraiser. If they're banging you on the fees and they're saying, well, we have to develop these forecasts. And if you have a company that's fairly stable, your expectation over the next 2, 3, 4, 5 years is that you're pretty much going to run at status quo, then building a really robust forecast will get you to the same exact number as if you just took the most recent performance, made some normalization adjustments to the single period to account for what the cash flow should be on the run, and then capitalizing that single number. So just something to be wary of as to whether or not someone's trying to justify, say, higher fees. But you really only need to do a projection in the DCF if you're expecting big changes to come. The investment value purpose might be a good example of that, where you want to include synergies or exclude synergies. You can't really do that with a CAP method. So CAP method, you normalize earnings, you determine you normalize historical earnings, you come up with weightings, you come up with the proper tax effects. And another thing to consider is whether or not you are a for-profit or not-for-profit when you are doing the valuation. You come up with a capitalization rate, which here's how you do that. You take the risk-free rate, this equity risk premium, small stock premium. Those are published numbers that Duff & Phelps provides guides on. Specific company risk is your fudge factor. The riskier the cash flows, the higher the specific company risk. Then you adjust for growth, meaning if I assume this business is going to kick off $500,000 a year, and I would discount that typically at 20%, well, there is the fact that the company you're valuing is going to grow at 2 or 3%, so you shave a little bit off the discount rate to get to your capitalization rate. So here we've done an example, a risk-free rate of 4.3%. That tends to be a long-term rate you use. You then you add an equity risk premium, then a size premium on top of that, as well as here's the specific company risk. We have an after-tax discount rate of 18%, but I said you want to consider growth, so you knock off 2%, and then you get to what the capitalization rate would be. Okay, so we have 15 minutes before the top of the hour, and I'm going to open up the floor to questions. Alex, has anybody asked any questions while we were chatting?
There were no questions. If anyone has any questions, you can go ahead and type them in the question box. We'll just give them a minute.
Give them a minute, and then if there's no questions, I can certainly go back to some of or if anybody wants to hear more detail on any of the methods or the approaches, let me know, and we'll knock that out.
Okay, so it doesn't look like anyone has any questions. Did you want to go over something else?
Yeah, so let me go back to the different standards of value, because this is really where you're going to find the critical hang-ups. So general market value for this audience is going to apply to service arrangements as well as investments in other entities, and also when you think about the buy-in for buying into certain practices or care centers. The general market definition, now that we have a little time, and so let's go back and read it really quick, right? So the general market value, this is public health. This is ground zero for all the folks on this call. The price that an asset would bring as a result of bona fide bargaining between well-informed buyers and sellers who are not otherwise in a position to generate business for the other party, or the compensation that would be included in a service agreement as a result of bona fide bargaining, again, not in a position to benefit. So how do you go about, right? If what they're saying is you have to value this company, but you have to exclude in your analysis any entity, any metric related to an entity that could benefit, how do you tackle that? Well, if we were valuing a service agreement, the way we would go about doing that is through both the cost and the market approach. Think about the cost approach as a proxy for the asset approach. And the way you employ the cost approach, say for a service agreement, is you lay out the tasks that the service agreement describes, right? It may be security, it may be maintenance, it may be nurse precept service, it may be it may be a physician that you're bringing on board in a compensation arrangement. And what you do is you identify, if it's a service, the org chart and the positions and skills and abilities required to deliver those services. So if you are, say, you have a service agreement to provide a clinic in a hospital or something, well, you need an executive, you need an administrator, you might need people working the front desk. Then you got to think about uniforms, supplies, rents, all of the stuff that would go into this kind of micro business, and build a P&L for that business. Then you turn around and say, well, if I had this staff and I had this overhead, what type of markup could I charge the users of my business for providing these services? And you can find those markups by looking at returns on assets of, say, management service organizations, MSOs. And so from a cost approach perspective, you basically build up to the services, apply that premium, and and you could stop right there and say my service agreement should run $100,000 a month, or you could look at the service cost relative to the expected revenue it would generate, and then the service agreement's going to say 10% or 12% of net revenue for the service agreement. You know, basically how much revenue is going to be generated against my cost plus services. If you're talking about physician comp, you know, MGMA, you know, our glorious benefactors here, you know, providing the sponsorship for this webinar, published some good data on RVUs. Now, don't fall into the trap of looking at the little table on the front page where it says, you know, average RVUs, mean RVUs by type of work, and then right adjacent, it has dollar amounts per RVU in the same statistical breakout. My understanding from the MGMA is that these are two distinct data sets, but a lot of people just kind of look at the row that says median and says, okay, $45 per RVU, average RVU is 4,000 RVUs per year. Let me compare that to what my doctor or my physician is doing, and, you know, voila, here's how much we can pay them. It's not that straightforward. but that is a good example of, say, to take that cost approach where you look at how much that charge would be, you add a markup, and there you go. The market approach for a service agreement is sometimes best served by dialing for dollars. So you have a service agreement between two entities, call MSOs and basically price shop what it would run for an MSO, a bona fide standalone entity, to provide that service, and you just jot down what they say it's going to run. Or you could look at the Form 990s published by health systems, and they usually disclose how much their management and consulting charges are. Well, you can compare that to net revenue, and oftentimes there might be enough detail to give you an idea of what a rough percentage is considered fair for two third parties engaged in a certain business activity. So there, if you use the Form 990s, if you dial for dollars, or if you use a cost approach plus a markup, you are avoiding picking up comparable companies that would be in a position to generate business and therefore be excluded. And the goal is you want to not stick your neck out. You want to be protected, and you want to make an argument that in the context of the intended user, he or she gets it. And what do I mean by gets it? Meaning the intended user, if it's tax or audit, has their rule book and you met the rule book, or if the intended user is the OIG because of a Stark issue, you know right away that they're going to look to eliminate the comparables that you selected because it may not meet this bona fide requirement. Okay, I'll pause there. We did a little deeper dive into general market value. Any questions on that?
It doesn't look like there are any questions. So if anybody has any questions, feel free to reach out to Howard. And the presentation will be available online for the members only section.
All right. Well, I want to thank everybody for their time today. Alex, thank you for hosting. And again, everyone have a good day. Feel free to reach out if you have any follow-up questions that weren't covered in the presentation.
Have a good day, everyone.